Welcome to this explainer. Okay, I want you to imagine a scenario for a second. You work incredibly hard for decades, faithfully putting money aside for your future. You think you're doing everything exactly right. But when you finally cross that finish line into retirement, you look at your accounts and realize, wait, half of my potential wealth has completely vanished.
It's a totally terrifying thought, right? I mean, where on earth did it go? Now, most people jump straight to the conclusion that it must have been some massive, catastrophic stock market crash that wiped them out. But, speaking as a financial mentor, I can tell you right now, that is rarely the case. The real culprits? They're these quiet, entirely avoidable mistakes you might actually be making every single week without even realizing it. The system will just quietly erode your hard-earned cash if you don't know exactly where the traps are hidden.
And just to give you an idea of the sheer scale of this problem, let's look at some recent data. A massive chunk of Gen Z and Millennials openly admit that entirely preventable financial missteps have already cost them over $5,000, over $5,000, and that's just early on in their careers. This loss isn't from making wild speculative bets on the market, it's simply due to a lack of core financial knowledge.
So in this explainer, we're going to fix that. As your financial mentor today, I'm auditing the absolute biggest investing mistakes Americans make. We're going to quickly walk through 6 invisible wealth leaks: the market timing trap, the free money trap, the lifestyle trap, the hype trap, the fee trap, and the emotion trap. And more importantly, I'm going to show you exactly how to plug them.
All right, let's dive right into our first one, the market timing trap and the massive cost of missing out.
So look, when the market starts dipping or the headlines are screaming about some impending recession, our natural human instinct totally kicks in. We want to sell everything, jump into the safety of cash, and just wait for the perfect time to buy back in. But data from Morgan Stanley shows us exactly what happens when you do that. If you try to time the market and you happen to sit in cash and miss just the single best week or month of the market's recovery, your lifetime compound returns literally get slashed in half. It's a multi-million-dollar mistake. The market's biggest gains almost always happen right after its absolute worst drops. So the golden rule: time in the market always beats timing the market.
Moving on to mistake number 2, the free money trap. This covers your 401k match and your taxes.
This one is a uniquely American problem, and honestly, it pains me every time I see it. Millions of people participate in their company's plan but completely fail to optimize it. Listen, if your employer offers a 3% or 4% match on your 401k and you aren't contributing enough to get that full match, you are literally turning down a 100% guaranteed return on your money. It's pure, free money, it's perfectly legal, and yet people just walk past it every single day. You've got to capture that match.
And beyond the match, there's the big question of where you put the rest of your cash. If you invest entirely in regular taxable brokerage accounts, you're voluntarily paying capital gains taxes every year. I always tell my mentees, doing that is like running a marathon with 10-pound weights tied to your ankles. On the flip side, using a Roth IRA lets your investments grow completely tax-free. When you finally pull that money out in retirement, the government cannot touch a single dime of your profits. Seriously, take the weights off your ankles.
Okay, trap number 3, the lifestyle trap. This is all about lifestyle creep and underinvested. This one is a total silent killer because it's not about what you invest in, but how much. You get a raise, so you rent a nicer apartment. You get a bonus, so you lease a flashier car. Your spending just creeps up right alongside your income, which means your actual wealth, it never grows. You wouldn't believe how many folks making well over 6 figures are still living paycheck to paycheck because of this. They mistake a high income for high wealth. To break the cycle, you have to treat your investments as a non-negotiable monthly bill. Step 1, the paycheck hits. Step 2, an automated transfer moves your investment money out immediately. Step 3, you only spend what's left. Automate it so you literally can't spend it.
Next up is mistake number 4, the hype trap, and the very real danger of chasing the magnificent 7. Right now, I know it is incredibly tempting to dump all your money into whatever trendy tech giants or AI stocks are dominating the news cycle. Their charts look amazing and FOMO is real. But history gives us a pretty stark warning here. Financial research tracking the largest U.S. companies from 1927 all the way to 2024 reveals a fascinating trend. Companies that heavily outperform on their way to becoming a top 10 stock, well, they almost always underperform the broader market after they get there. When you buy a stock at the absolute peak of its popularity, you are buying it when it's the most expensive. So how do we fix this? We use index funds. Now, if you're new to the term, think of an index fund like this. It's basically like buying the entire grocery store instead of taking a massive gamble on guessing which single specific box of cereal is going to be this year's bestseller.
By buying a low-cost index fund that covers the whole S&P 500, you just own a piece of American capitalism as a whole. You drastically reduce your risk, but you still capture all that sweet, sweet growth.
All right, trap number 5, the fee trap. This focuses on ignoring those high expense ratios.
Honestly, as a mentor, this trap boils my blood because it's a silent tax most folks don't even know they're paying. When you use a traditional advisor or buy a standard mutual fund, you might see a fee of 1% or 1.5%. Sounds tiny, right? Almost like nothing. Well, let me give you an analogy for what an expense ratio actually is. Think of your retirement portfolio as a bucket of water that you have to carry on a 30-year hike. An expense ratio is a tiny leak at the bottom of that bucket. A 1.5% fee sounds like just a single drop of water, but over a 30-year hike, that slow, continuous drip drains a massive chunk of your life's water supply.
And what's really terrifying here is the actual math. If your portfolio earns an average of 8% a year, a 1.5% fee isn't just taking 1.5% of your profits. No, it is actually stealing nearly 20% of your total compound growth away from you every single year. Choosing a high-fee fund over a modern low-cost index fund that charges something tiny like 0.03% means you're just voluntarily giving away hundreds of thousands of dollars to Wall Street managers for absolutely nothing in return.
And that brings us to our final mistake, number 6, the emotion trap, and the endless cycle of greed and fear.
This connects all the mathematical errors we just talked about to one deeply relatable human flaw: letting your emotions run the show. The stock market, at its core, is a highly efficient machine designed to transfer money from the impatient to the patient. There's this vicious emotional cycle that traps retail investors every single decade. Step 1. The market is skyrocketing, FOMO kicks in, and people buy at the absolute peak. Step 2. The market inevitably corrects. Step 3. That initial greed turns into absolute terror. And finally, Step 4. They panic and sell at a massive loss. To be successful, you absolutely have to disconnect your emotions from your portfolio.
Because look, true wealth building doesn't require a genius IQ. It's really all about automation, consistency, and discipline. So as we wrap up this explainer, I want to leave you with one absolutely critical question to ask yourself tonight. Is your portfolio built for your actual psychology? Seriously, if logging into your account and seeing a 20% drop is going to make you lose sleep and panic sell, then your portfolio is simply too aggressive for your true risk tolerance. Fix these leaks, automate your discipline, and let compound interest do the heavy lifting for you. Thanks so much for joining me for this explainer, and I challenge you to audit your own accounts this week. Where is your wealth leaking?